Welcome on board Samir Aurora, founder at Helios Capital, and find out what he's making of the market right now. Samir, hi, morning. How do you make sense of this week? From that manic Monday to finally some stability coming in, what's happening?
So the only day that makes sense to me is today. This is the thing which is more what I should, at least after that fall. The thing is that when people talk about, oh, we are very conscious and cautious, it just reflects a bit of thought and, oh my God, risk control and other things. The reality is that most of the time markets are up in general. Over the last 3 years and 2 years, the Indian market, if not defined by some 10 mid-cap and small-cap stocks, but by Nifty and 500, which is what the market is, it has gone up much less than its historical averages. If you saw till yesterday, I think Nifty was up, 9% per annum for 3 years. And this, by the way, is in rupees. And if you make it in dollars, then in 22, the currency lost 10%, and since then, maybe another 4%. So cumulatively, the foreign investor would have made maybe 5-6% per annum. And this is what we call the bull run. Even if we look at 50 and 500 index, it was up, I think, 13 or 14% per annum in rupees. So cut 3% for tax, for depreciation of the rupee. So at a 10% appreciation per annum, we are trying to tell the world that, this market has gone up too much because one stock, one trend, one Zomato, one here and there, which if you look at a portfolio level, won't be even more than cumulatively 10% of any or 15% of any. So I always felt that there is no reason for the market to correct and be manic about it. You can say, okay, it'll be remaining in this range, it'll be plus minus this, and gone up a little, gone down a little. But for some reason, we have taken it as if we are having a bull run of our life. I don't think we have, these guys, not me, these guys have seen what is a bull run. We are underperforming US. Post-tax, the returns are even lower. The normal funds across would make maybe 13-15% in rupees. And as you know, even mutual fund returns are actually pre-tax. And for these returns, they have everybody in India saying, oh my God, what a bull run. We have not had a bull run. We've had a decent run.
Bit of a differentiated view, Samir, because everyone else is telling us that we need to calibrate and moderate our expectations because we have done so much better perhaps in the last 4 years. But you are saying this is normal and we should still anticipate 15% kind of return from Nifty this year.
No, first of all, it's not a matter of discussion. The Nifty number is real. So please, you after this, properly do it on a screen for 3 years. Now, don't do 2 years, then I'll say do 7 years. 3 years is a normal this thing. And for 3 years, you put, or even you do put 5 years, 7 years, whatever you want to put. And then also put it in dollar. And then just put it in perspective. Let's say, take the same number for 10 years and 15 years. Or 20 years. And if the last 3 year numbers are lower than 10 years and 15 years in INR terms, and in dollar terms, even more so, because that 10% depreciation just happened like in 22, and then another 4-5 since then. So it's not a matter of discussion. It is what it is. Why are we saying, what do you think? Say, what is the number? Now, the second thing they will say is that the premium is very high to other markets. That other market includes China, because of which all the emerging market, this thing goes wild. So I'm not saying some great bull run is going to happen, but this idea that the market will fall 15% or 30%, if you see the previous 3 bad years that were there, which is say 2008, 2000 or 1992, where people would be better off raising cash at the end of the previous year, then the previous years were very, very big. In 1991, the market Sensex was up some 60-70%. In 2007, because that time NSE 500 and all were also there, they were all up some same 60-80%, and same thing in in 99 and then 2007. You don't fall after a 10% move. I mean, you may fall, but you don't anticipate it every morning saying that. Oh, so much has happened. The market was up 9% in rupee terms. I think it deserves a crash for that. Now, the second thing can be, what are the results? And the results are not good. But that seems to be induced by bad policies. One of them from the RBI to make everything so tight, the loan growth so tight, forcing poor HDFC Bank to immediately after a merger, say, bring your deposit to credit ratio, credit to deposit ratio down to 80s. How? So you randomly forced a slowdown in this thing. You made MFIs that instead of 3, you should have 2. You told the NBFCs that you can't grow more than 25%. All these things induced it. Now they'll correct over time, and slowly you'll be okay in life.
I take your point, Samir, partly, but just to kind of counter it a bit, do you think it's fair to only look at, let's say, valuations or return only from Nifty perspective? Because
No,
it's the
500.
broader markets which have run up
500.
almost 20-25% on a, more than that actually if you look at the 3-year CAGR.
No. If you look, please look right now. If you give me 1 second, I will tell you right now. Look at it right now. Don't look at small cap index. Look at the 500 index, which is the S&P 500 equivalent.
Yeah,
You'll see it for 3 years.
No, but
It'll
the
be
point.
around 15.
No, so that's what I'm trying to say. The broader end of the market has done better, and I'm not talking about the top, just say 100 companies, but beyond that.
500. We are talking about 500 companies.
Okay, let me look at the NSE 500 for 3 years. In the meantime, but continue with your point.
So I was saying generally that in every market you can say, oh, these 10 stocks have gone up. It is our whole thesis of our fund, philosophy, which is available online and all, is that every day, literally every day, broadly every day, some 150 stocks, 200 stocks are massively beating the market, and some 100 and 150 stocks are massively being beaten by the market. Okay, that's the big picture. So all the time you will find, now if you say, no, I'm only looking at this, I'm only looking at that, the reality is, therefore the best way is to say, what is the mutual fund industry's, entire industry's returns? Because that is the total investors who are there. Don't say this small cap fund, because if one small cap fund has done well in line with the index, that means, okay, don't buy small cap right now. I agree. But you can't say the market. You keep saying the market when it's not the market. It is a number of stocks, but then you have to see money-weighted returns. Money-weighted returns are the entire returns of an index or the market or the flexi cap guys. Now, don't say that one defense sector has done well. Okay, then don't buy defense stocks. Somebody will say some other platform. We don't believe because we still like the platform. But if somebody says platform stocks have done too well, okay, don't buy them. But the point is, you can't brush and say that the market has gone up too much, because the market is the 500 index as far as practical sort of measuring of it is concerned. But please tell me what you come up with, or I can do it in 1 second if you let me turn around and show you my back.
If you're talking about the same index and the same levels,
3-year returns.
No. So 3-year return, if I look for Nifty 500, is 35% CAGR, because in 2022 it was around that.
No, please don't do like that. It's absolutely no chance.
I don't know. Maybe we'll connect offline and discuss this further. I think I'll let the discussion continue. Because I'm looking at a level of 21,800 right now. It was around 11,000 in 2021. 13,700 in 2022. But I don't know. At least it seems like it's a gain of around 30%. I can be incorrect there.
For 3 years, starting today and going back 3 years, from exactly the date, is up 12.9% per annum for 3 years. The cumulative return is 43.9%.
Okay, I think we'll connect off the record, Samir, and just match these data points. Maybe we're looking at
January 1422 to January 1425. 3
okay.
years.
All right.
Because remember, 22 was a very bad year.
Yeah.
It was down. 23 was very good.
22 was a bad year. Yes, it was down.
The whole point. The point is, you've always had in between bad years. So people say that, if you do it for 5 years, it looks very good. You make it 7 years, it looks ordinary, because 19 and 20 were very bad. So that's what you can't just randomly choose. Therefore, you choose 3 year, 5 year, 7 year, 9 year, 15 year, 20 year, and see if something looks out of line. It need not be that the returns in that period are good because something extra happened. It could be that The previous 2 years were very bad. So, for example, in 2009, could somebody say, oh, the market is up 70%, therefore it's a sell? No, because in 2008, it had fallen 60, 70%. And some of what happened in 9 had nothing to do with economy and interest rates. It had to do with the correction of that big fall that may have not been justified in hindsight. So same thing, we keep looking at it from
sure,
20
Samir, definitely
January
we take
to
your
now.
point, and we'll try to get more understanding on that figures,
colours
but maybe
everything. You see,
offline.
that colors everything. If you
Color
feel
is
that the
everything,
market
Samir,
is negative,
and
then everything is
the
negative.
key headline for us that you're not expecting a big correction in the market at this point in time. And looking at the chart today, definitely we all are happy about it. But tell us what, Samir, there's been a lot of sector churning that we are seeing. We know about your take on the IT space. You have been quite gung-ho about that. And we also know about some of your favorites from the other sectors like Paytm. And on the flip side, autos was not looking attractive to you, and so was Tata Motors. But help us understand what are the sectors that you're keenly watching out for when it comes to 2025, and how do you see the sector churning at play?
So I think the worst sector globally and locally, in theory, has to be auto sector. I have one, actually it came yesterday in your paper also, which I have been saying for 3-4 weeks now, that India has to make peace with China. At least in areas which are not sensitive or security type related, because in some of these areas, China is so far ahead of India. And these would, as of now, include EV and maybe solar cells and all these things where you can close yourself and say, I will help 2 Indian companies and 2 Indian promoters. But how does that help the world or help India in any way? Just because if 2 business owners own 1 auto company each or own some 3 solar companies each. The point is that in some of these areas, you are never going to catch up. So the best way is to let those guys in, force a partner on them, force how much X amount, stake they can have, force some localization requirements, force some export requirements, but let them in. But imagine if 2 of those are allowed in. If they are partners of our existing companies, then those companies will do well. But if their partners are some new companies, then our existing guys will fall 50%. And big picture, if you look at the global sector of auto, and you see any country you can pick up from Japan to US to Europe and see what is happening. So if you think that India is in these things doing even better, then why are we bearish in the first place on India and Indian economy if we say that a theme which is not working in a single market in the world is going to work in India because we are growing more? Then anyway, we should be bullish on our market. So it is not consistent. In terms of the positive things, I think that over the next 6-9 months, the financial sector will do better. And after maybe 6-9 months, it will be led by HDFC Bank. It may still do a little okay now because you have compressed it for too much time by saying that you absorb HDFC, but also simultaneously reduce your CD ratio. I mean, it is so unfair, it is beyond limit. That this much growth without taking over HDFC, they could have done on their own. They could have grown 15-16% per annum on their own in their loan book, in their size, and they would have been bigger than what they are now, because you said now take over, because the requirement is also the system that NBFC should become banks and all that. And then to say in a compressed period do it, which hurt them and the economy, but everything will get repaired. So now the question is what happens to the budget and all, where I don't think much will happen, but on the margin, there might be some tax cut for somebody or change the bracket. So everybody might have, I don't know, let's say 2,000 rupees more per month, or let's say. So we were thinking if that happened, who will be the biggest beneficiary? And we said, who knows? But maybe they'll just order more things from Zomato. So we are happy with that.
All right, Samir, great to have you. We are a little squeezed on time today, but definitely great to have your perspective on the markets and also the sectors. But we'll try to take that discussion forward maybe some other time.
If you like this video, then like, share and subscribe to ET Now.